Are you thinking of buying a home in Ireland? Well, before you get mortgage approved, stop. Because what the bank says that you can borrow may be very different from what you can actually afford. In this video, I will walk you through the numbers, the rules, and the hidden costs that determine what you can really afford, not just in paper, but in real life. We'll cover the central bank limits and how they affect your approval, what lenders look for behind the scenes, and the real cost of home ownership that most people miss. Hi, I'm Elliott. I'm a financial planner based in Ireland, and every week I speak with clients across the country who are navigating the exact same question. How much house can I really afford without compromising my future? And it's a question that has never been harder to answer, because right now, Irish buyers are facing a steep climb. Property prices are near record highs. Median home prices have jumped 42% in the last 5 years. Interest rates have doubled in the last 3 years. And supply, well, it's still deeply constrained. So that's why it's not enough just to get approved. You need to get really clear. So let's break it all down. So let's start with what the Central Bank of Ireland actually allows banks to lend, and why that might be very different from what you should actually borrow. There are two key rules every mortgage applicant in Ireland must work within. The first one is called loan to income. This caps how much you can borrow based on your gross annual income. For first-time buyers, they can borrow up to 4 times their gross income. For second and subsequent buyers, they're capped at 3.5 times their gross income. So if you're a first-time buyer earning €60,000, the most that you can borrow is €240,000. And a second-time buyer on the same income, well, the most that they can borrow is €210,000. Now, banks can approve some borrowers above these caps, but those exceptions are tightly limited and not guaranteed. The second rule is called loan to value. This defines the minimum deposit that you need. So for first-time buyers, the minimum deposit is 10%. For second or subsequent buyers, it's 20%. Buy to let, 30%. So let's say we take a home valued at €350,000. A first-time buyer will need to put down €35,000. All the additional closing costs, such as the legal, stamp duty, etc., are in addition. These rules are strict for a reason. They're designed to make sure buyers aren't over-leveraged, especially in a rising rate environment. Despite political and market pressure, the central bank has made it really clear. In a recent interview with the Sunday Times, the governor, Gabriel Makhlouf, ruled out any easing of the mortgage lending rules, stating that the real issue lies in the lack of housing supply, not restrictions on borrowing. In his own words, he said, relaxing lending limits won't fix the market, it could make it worse. The central bank's view is straightforward. If you let people borrow more in a market where there simply aren't enough homes, all you will do is push prices up further. But here's where the disconnect happens. Just because you meet the regulators' criteria doesn't mean that you should borrow that amount. These rules don't account for your personal circumstances like childcare, future savings needs, retirement plans, emergency funds, or even just your regular household bills. That's why you need to go beyond these lending limits and look at what is affordable for you. And that's what we're going to look at next. Now let's look at what the lenders actually do behind the scenes when assessing your mortgage application. Because it's not just about the central bank's limits. Yes, they do apply the loan to income and the loan to value rules. But beyond that, every lender has their own affordability model. And they're quietly running these numbers to stress test your ability to repay. Not just today, but in scenarios where their interest rates would increase or your personal circumstances may change. Behind the scenes, lenders often apply the 28-36 rule. It's a global standard that's quietly becoming common among Irish lenders. Here's how it works. Rule 1, 28%. Your monthly mortgage and related expenses, including the principal, interest, property tax, mortgage protection, and insurance, should not be more than 28% of your gross monthly income. Rule 2, 36. Your total monthly debt repayments, including mortgage, credit cards, car loans, and other, should be no more than 30% of your gross income. These numbers aren't about generosity, they're about risk. The rule is designed to keep borrowers within a comfort zone where they're unlikely to default even when things get tight. So let's look at an example. Let's say you earn €80,000 per year. That's about $6,600 per month gross. Under the 28% rule, your maximum mortgage and related costs would need to be below $1,850 per month. Under the 36 rule, all debt combined, or again your mortgage, car loan, credit cards, etc., must be under $2,400 per month. So even if the central bank's rules said you can borrow €320,000 based on the loan to income limit, your ability to repay under this framework may be capped by your actual repayment headroom. especially if you already have existing debt. This rule tells lenders whether you qualify, but it's still not whether you're comfortable. It doesn't know if you're trying to build up long-term savings, if you're planning for future child costs, or if you want to retire early. Lenders' models work for them, but you need a model that works for you. That's why in the next section, I will introduce you to a robust affordability framework that goes beyond eligibility and starts with your real financial comfort. Because being mortgage approved is just one piece in the puzzle. Living with that mortgage comfortably, consistently, and without regret is something entirely different. Do you want clarity on what you can actually afford, not just from a lender's point of view, but in the context of your entire financial life? Well, that's exactly what I help my clients do. Whether you're a high earner professional or business owner across Ireland, I help people like you every single week. Whether you're buying a home, growing a business, or investing for your future, we'll build a clear, strategic, compliant, tailored plan that meets your goals. And if you're ready to cut through the noise and make confident financial decisions, book a private, no-pressure consultation. You'll find the link in the description below. So now that we've covered what the banks are looking for, let's talk about what you should be looking for, because mortgage approval doesn't equal affordability. So let me introduce you to the 30-33 rule. It is a practical framework to stress test your comfort level. It essentially asks one question: can you afford this home and still live your life? So rule 1 is spend no more than 30% of your gross income on housing costs. This includes mortgage repayments, property tax, and home insurance. It does not include utilities, maintenance, or repairs. If your gross income is €100,000, this means keeping your housing costs under $2,500 per month. This isn't the bank's rule, it's yours. Rule number 2, have 33% of the purchase price saved in cash. That covers your deposit, whether it's 10 or 20%, stamp duty, legal fees and insurance, and a buffer, ideally 6 months repayments. So for a €400,000 home, that's roughly $132,000 in total savings, or the continued cost of living. The 30-33 rule is an ideal benchmark for affordability so that you are not overly stretched and could cushion an unexpected event like a pay decrease, increased interest rates, or continuing cost of living increases. You could apply a sliding scale, but it does hit the danger zone when you move into the 40-20 zone. That is 40% of your income going in housing and just 20% saved. If you're in the zone, move carefully and plan deliberately. The bank's job is to assess the risk to them, but your job is to assess the risk to you. This rule puts your goals and your comfort at the center. Not just a loan amount of paper, but what you can actually afford. So let's say a couple earn €100,000. They could borrow $400,000, and with a 10% deposit, they're shopping for a property around $440,000. So what does this buy them? In Dublin, maybe a 2-bed apartment in a suburb. Outside Dublin, a solid 3-bed semi-detached in a good town. So repayments on $400,000 over 30 years at 4.25%. That's about $2,000, which is well below the 30% threshold. Let's say the numbers didn't work. What would you do? Well, what you could do, unfortunately, is adjust your expectations. Look at the type of home or the location, or potentially hold back on your timing. Remember, don't let your dream home become a financial burden. You've probably heard that mortgage rates have gone up, but what does that actually mean for your ability to buy? The short answer, a lot. Interest rates directly affect your monthly repayments, which means that they directly affect how much house that you can afford. Even a small increase in rates can have a big impact on your budget. Back in early 2022, mortgage rates in Ireland were as low as 1.9%. But today, most fixed rates sit between 3.1 and 5%. Your rate depends on a number of factors: the deposit size, the property's BER rating, and your lender. So let's break that down. At 3% interest, a €350,000 mortgage over 30 years works out about $1,475 per month. But if it was 5%, the same mortgage jumps to $1,880. That is a 27% increase, roughly €400 more per month. And over the life of the loan, that is over €140,000 in extra repayments. So yes, affordability can disappear fast, even if your income stays exactly the same. So where do these rates come from? Well, mortgage rates are a combination of the ECB base rate plus the lender's margin. The ECB main finance rate is 2.15% as of June 2025, and the lender's margins range between 1 and 3%. ECB rates raised aggressively in 2022 and 2023 to fight inflation. Now inflation is easing, the ECB has cut rates back to 2.15%, and some analysts expect further cuts towards the year end. But nothing is guaranteed. repeat. If rates fall next year, that won't change the cost that you face today. So what are the key takeaways here? Rising rates shrink your buying power. That means one of three things. You may qualify for less mortgage, you may need to rethink your location or size, or unfortunately, you may need to delay things longer. This is why a personal affordability rule like the 30-33 rule matters so much, because borrowing isn't the same as being able to sustain payments. Your financial peace of mind shouldn't depend on a best case scenario. Okay, so far we've looked at how much you can borrow, how interest rates and affordability rules shape your budget. But once you buy the home, the costs don't stop there. Owning a home in Ireland comes with ongoing financial responsibilities, many of which are easy to underestimate. And if you don't plan for them early, they could stretch your finances very quickly. So let's look at what you need to budget for beyond the mortgage. Mortgage protection and home insurance. These two are mandated by most lenders. For mortgage protection, the range is usually between 20 and 50 euro per month, depending on health factors. For home insurance, the average property ranges between 450 and 850 per year. Now, many factors will impact the price: rebuild cost, age, location, etc. Next is a local property tax. It's based on the market value of the property on the 1st of November 2021. So let's say your home is valued at 400,000. It falls into the band of 350 to 437,000, and the annual local property tax is 405 euro. Next is maintenance and repairs. A good rule of thumb is to budget for 0.5% of the property's value per year. So let's say your home is worth 400,000, you would set aside 2,000 a year for maintenance and repair. Even if you don't use it annually, it's good for it to build up over time so that you have essentially a rainy day fund. And then we have the one-off or setup costs. These are really easy to overlook, but are very real. For example, stamp duty. So there's 1% on the value of your home up to 1 million euro. And legal fees for the solicitor's conveyancing can range from 2,000 to 5,000 plus VAT. Then there's lifestyle costs, which are furniture and fittings. These can cost up to tens of thousands of euro, depending on the size and style of your home. These aren't always extras. They're part of the real cost of homeownership. Ignore them and you risk maximizing on your mortgage with no room left for life surprises. That's why rules like the 30-33 framework and keeping a strong emergency fund aren't just nice to haves, they are your financial safety buffer. So let's pull it all together with an example. Let's take Sarah and Mark. They earn 100,000 euro combined and they're approved for a 400,000 euro mortgage. 10% down, they're shopping for a property for around 445,000 euro. So let's look at the 30-33 rule for them. 30% of the gross income is 2,500 per month. Their mortgage at 4.25% will be 1,950. When we add in insurance, local property tax and maintenance, it's working out about 2,300. Still well within the comfort. Now let's look at the 33% check. So 10% deposit is 44,500. Fees and taxes of around 8,000, and in the buffer, including the 6 months of repayments and setup cost about 95,000, the total savings required is 147,000 euro. So you've just gained a real-world framework for buying a home with confidence, not just approval. Now you understand how interest rates impact your buying power, why the central bank rules don't tell you the whole story, what lenders actually look for behind the scenes, why the 30-33 rule and knowing your risk zone matter, and the hidden cost most buyers don't pay attention to. Now the question is, what are you going to do with all this? So step number 1 is start with your income. Step number 2 is cap your housing costs at 30% of your gross income. Remember, this includes your mortgage, home insurance, local property tax, all in. Step 3 is build a real financial buffer. 6 months of core expenses for peace of mind, not just emergencies. Step 4, include the full cost, stamp duty, legal fees, maintenance and furnishings. Step 5, borrow smart, not big. Make sure your mortgage supports your lifestyle, not strains it. This isn't the end, it's just the beginning of making smarter, more strategic financial decisions. If you're planning to buy, already own and want to build real wealth, don't guess. Let's build a clear, tailored plan that links your home, your savings, your business, and your future. Book a private strategy session, no pressure, just clarity. You'll find the description in the link below. And if property investing is on your radar, don't move forward until you've watched the next video with my full explainer on choosing the right ownership structure in Ireland, so you can avoid costly mistakes and save thousands in tax.